Hello, and welcome to The Upside. I'm Lauren Gardy. Today, we're talking about alternative investments, and I'm joined by our in-house product expert, Rory Poole. So Rory, why don't you kick off by telling us exactly what you and your team do here at Fidelity?
For sure, Lauren. Thanks a lot for having me today. So myself and a team of folks are responsible for really all the research and development that we do around the various alternative strategies or funds that we offer to investors. So happy to unpack some concepts today and talk a little bit about maybe a part of investing that investors at home are a little bit less familiar with, but hopefully in the future we'll warm up to a little bit more.
Great. So let's start from the basics. I'm just at the beginning of my investment journey, long-term time horizon. I've been hearing a lot about alternatives. There's a lot of buzz around them, seemingly on a lot of investors' minds. I'm curious, what actually is classified as an alternative, and why are so many people interested in them today?
Yeah, sure. So there's a couple questions within that, but maybe we'll just start with the simple concept of what is an alternative, and I think that the best way that I would explain it to folks is it's just something different. And you probably ask, okay, well, different relative to what? Different relative to the three kind of core traditional areas that investors tend to have capital invested within their portfolio. So whether that's stocks, bonds, or cash. And to be a little bit more specific, they're different in terms of how they behave within the portfolio. So there may be times when your stock portfolio or your bond portfolio is going up, down, or sideways, and an alternative that you own within that portfolio may be doing something different. So the benefit of that, which I think we'll probably talk a little bit more about today, is that it provides a little bit of an added layer of diversification within folks' portfolios to varying degrees. The second part of your question was kind of hinting at the fact like, hey, these are becoming a little bit more popular, a little bit more mainstream. Why is that the case? And I think from my perspective, there's really two answers to that. The first is simply access. Access to alternative solutions or alternative investments has gotten dramatically better for the end investor over the course of the past 5 to 10 years. There's a number of reasons as to why that's the case, but simply put, is a lot more feasible, attainable, scalable for an investor to actually hold some of these options within their portfolio if they choose to do so, relative to maybe the decades past. And then I think on top of that, we, like many facets of our lives nowadays, there's a big influence from the attention that comes from the media as a result of that. So more access, more options for investors. Well, the Bloombergs, the CNBCs, whatever investors use for the purposes of their financial news, will pick that up. One of the best examples of that, which is an alternative investment, is the emergence of cryptocurrency over the course of the past 5 or so years. You really can't go a day without looking at one of these financial websites or financial forums that does not necessarily mention that. So I think it's the combination of end investors having a greater ability to actually own some of these things, coupled with the fact that media is so influential in our day-to-day lives.
Mm-hmm. I'm sure we've all experienced how much media influence can impact broader decisions too. So I wanted to dive into something you mentioned about fitting alternatives into a portfolio. So as I mentioned, I have a long-term time horizon. Compared to someone who's more of a retiree, maybe has short-term cash needs, how would you sort of universally describe alternatives fitting into portfolios, and how do they work amongst different investors?
Yeah, I think that alternatives come in so many different shapes and sizes. I think that there's really something out there for everyone. So let's use your comparison specifically to talk about that a little bit more. So let's say, Lauren, that as you mentioned, you are a long-term investor. Maybe you have a slightly higher risk tolerance. There are plenty of alternative options out there for folks that may target or aim to generate higher returns than that of what you might get within a traditional stock portfolio. There's some compensations that you potentially have to pay for those higher returns, whether it's through things like fees or whether it's through things like liquidity. But most certainly that can be suitable for an investor of that type. On the flip side, if you are a retiree or someone that's getting closer to retirement, as you mentioned, maybe you're someone that has a higher need for cash flow within your portfolio. Maybe you're someone that's a little bit more risk averse. Well, guess what? There's options out there in terms of alternatives that can potentially produce more income for your portfolio based on the different techniques or portfolio manager approaches that can be utilized. There's also options out there that use different measures to potentially dampen volatility or reduce correlation, meaning the relationship between the big three that I talked about before, stocks, bond, and cash in your portfolio. And guess what? You don't necessarily have to lock your money away or sacrifice the liquidity aspect that I just alluded to in the prior example. So that's a long-winded way of saying when looking at different types of investors, I don't think it's like a red light, green light type of answer or question for that matter. It's more so investors asking themselves, what's the best alternative for me?
Mm-hmm. That's great, Rory. And you're piquing my interest here. So I'm curious, if I were to invest in a liquid or an alternative, I can do that either through an advisor or directly with the asset manager. Could you compare and contrast the differences between those two avenues?
For sure. And we just talked a little bit about it, but I think that without getting into the minutia of all of the different types of alternative strategies or funds that are available out there to investors, I'll more so just be generic and focus on what I mentioned and what you were, I think, kind of hinting at there, which is the difference between a liquid and an illiquid alternative. A liquid alternative, as the name indicates, will typically provide investors with a relatively high degree of liquidity. And all that means is that their ability to turn an investor's investment into cash, if they so choose, is fairly high. So what it means in practice is that typically on a daily basis, if said investor were to want to sell that alternative investment and receive cash from that sale, the manager has the ability to do it. So there's plenty of liquid alternative solutions that are out there that cater towards different aspects of investor portfolios. On the flip side, there's what I would say are kind of less liquid investments or illiquid investments. And those are investments in potentially assets or strategies where it's a little bit more difficult or it takes maybe a little bit more time to turn that investment into cash. A good example of that would be a private real estate type of fund that investors may wish to hold. There's a lot of benefits with potentially holding a private real estate fund. The difficult thing is that when you invest your capital with that manager, what they're doing is they're going out and potentially buying physical assets like buildings or shopping centers or you name it. And as a result of that, as you can imagine, it's not so easy to necessarily sell that apartment building or that shopping center overnight and then return cash to investors. Not to say it can't be done, it certainly can, but it takes a little bit longer to do that. So when I think investors are shopping around or talking to their advisor about, what is best for me, that kind of liquidity conversation, or am I best suited to own something that is a liquid asset, or am I a little bit more interested for a portion of my portfolio to own something that's less liquid, is certainly something that should be top of mind.
Mm-hmm. That's very helpful. Thank you for level setting that. You touched on fees earlier, so I'm curious. I've heard lots of jargon thrown around in terms of various fee structures. Seemingly, these different types of alternatives have different structures as well, and each provider maybe changes how they charge fees a little bit differently. How would you best summarize, if we can, how fees apply across alternatives?
Yeah, you made mention of the fact that there's just tons of variability out there. There's certainly, I think the stigma with a lot of alternatives is that they're really expensive. And there certainly are alternative strategies and funds out there that are more costly, in some cases for very good reason, relative to a traditional fund or investment that you might own. But also, especially with the advent of these more liquid forms of alternative investing, there are lots of options out there for investors if they want to pay something that is more comparable to what they would pay as a managerial fee for owning other assets within their investment portfolio. But I think that probably the most kind of polarizing of all of them is the essence of a performance fee or an incentive fee, which sometimes can exist on alternative funds, not, I would say, all of them out there. But just to explain a little bit about how that works for investors, performance fee is essentially a fee that a manager would charge for meeting certain performance criteria within the portfolio. So I think the best way to maybe illustrate that for folks is to try and give a little bit of an example. And the thing that comes to mind first and foremost for me is like going out to a nice restaurant for a nice dinner. It's the same. It's the same kind of thing that investors think about when it comes to comparing the value or quality of something relative to the price that they actually pay for it. So using our dinner example, if I go out to a nice restaurant for dinner and the food's great and the ambiance is really nice and the service is 10 out of 10, then guess what? I'm happy to pay a higher price for that. But if I go to that restaurant a week later and for whatever particular reason, the food wasn't very great, or my service was really slow, or it was too loud in there, or for whatever particular reason, you're probably less inclined to go back and pay that price again for that same service that you're being provided. Now, it just so happens in this instance, it's a little bit more sensitive because it's your investment. But again, the assessment from a consumer's perspective of, what am I willing to pay based on the value or the quality that I'm getting out of it, it carries over to this form of investing as well.
So you're saying you're willing to pay more for a better experience.
Exactly. That's the simple way to sum it up. And maybe not everyone out there is. Maybe some people look for, going back to our dinner example, maybe they look first and foremost at price. But I think that you'll find a range of individuals out there that may take either end of that argument, and hence why, as I mentioned, it's a little bit more polarizing. But certainly, if the value is there for investors, I think those fees can be justifiable.
For sure. Well, thank you for that, Rory. And you mentioned stigmas earlier. So there were a few that came to mind for me when it comes to thinking about alternative investing. Say the first being that they could be very risky. Secondly, maybe you mentioned transparency, that it might be hard for the end investor to know really where their money's going and what's being purchased. And the final one being that, are these alternatives really just meant for ultra high net worth investors? What do you think about that? Is that fact or fiction?
Yeah, so let's parse through each one just briefly. So you mentioned first kind of the risky aspect of it. Certainly not. There are a full gambit of opportunities for investors out there within alternatives. Some are certainly more risky. They may come with unique risks relative to what they experience in their stock or their bond portfolio. But there are plenty of options out there for investors that are lower down the risk scale if you're kind of defining risk by the volatility or the amount that the investment moves around. The second thing that you mentioned was transparency or a lack thereof. And I think maybe over kind of 10 years ago, if you were to go back, that's a fair argument. I think it's less so now. And I think that a few things are changing that. One is the amount of competitive pressure that's occurring out there. So we talked earlier about the fact that mainstream media seems to be talking a little bit more about alternative investing, especially for the end investor. Well, guess what? What that does is it puts pressure on the manufacturers of these products or the asset managers like the Fidelities of the world to make sure that we are delivering that service and that transparency as best as possible to investors. So nowadays, with, as I mentioned, especially with after the advent of the liquid alternative options that are out there, and even with some of the less liquid alternatives, transparency has certainly improved dramatically over the course of the past 10 years. The last point that you made there was in relation to like this really only being an area that's accessible to like very affluent or ultra high net worth or institutional types of investors. And that's simply not the case anymore. I think that the financial industry over the course of the past little while in particular have made a lot of strides in terms of creating products, creating different vehicles where investors of all types can access these things, and they don't necessarily need to pay an arm and a leg in order to do it. So going back to something that we talked about previously, just that question of, you know what, which alternative is best for me? If I were to give folks at home a piece of advice, like if you work with an advisor, ask them that question. If is an alternative type of a product based on what I'm currently invested in, is that the type of thing that we should potentially talk about? And if so, what's the best option for me? Because there are so many different types of strategies, funds, products that may improve investor experiences and hopefully improve goals for investors over whether it's the short, medium, or longer term.
Thank you for that, Rory. And the advisor is the expert in terms of all things alternatives here. We appreciate your expert insights from Fidelity today as well. And thank you to our viewers for joining the show today. You can find more investor content from Fidelity at fidelity.ca under the Investor Education section. Sign up for articles, the Upside newsletter, and get more information about upcoming live webcasts. Thanks for watching, and I hope you'll join us again on the Upside. I'm Lauren Gardy.